Good morning, guys. Made it to Friday. Woohoo, we're here again. Okay, so today I kind of want to go on a little different path. And you know me, it's usually you never know what you're going to get when you wake up in the morning, and that's pretty much the fun part of it. You know, it's like Forrest Gump said, life's like a box of chocolates. You never know what you're going to get. So welcome to Box of Chocolates Friday morning. Today, what I kind of wanted to talk about a little bit is the economic side of prepping and what all we do again. Now, if y'all remember, about a month or so ago, I was talking about where we were getting into feudalism, okay? Talking about all of that. You know, we're going back toward the Middle Ages where, you know, you had a king who basically got all the wealth, and then you had all the paupers, you know, which was basically the population, right? Well, we're kind of there, or at least heading that way again. And if you look at society, all right, and think about this over, say, the last 30 years or whatever, and a lot of what we hear day in and day out, you know, Jeff Bezos, Bill Gates, Warren Buffett, they all get richer and richer and richer and richer and richer, okay? And what do you hear about you and me, okay? Joe Average here. You know, all we hear is our debt level is going up, 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 okay? So what you're seeing is the wealth all being concentrated amongst the 1%, as the liberals like to call them, okay? And the 99%, the rest of us here, are stuck holding the bag. We owe all the money. Now, if this kind of sounds like going into the World Economic Forum of you'll own nothing and be happy with it, that's kind of exactly where it's going, all right? Is they're going to own all the wealth, and you're just going to be allowed to have whatever they, out of the grace of God, decide to give you, all right? You know, personally, you know, I'm trying to pay off my house and, you know, pay off my land and everything, so I own it, and I really don't feel like giving it away to the powers that be. Now, this also kind of comes into play a little bit with the stock market. And if you all remember, I've told you before, you know, back late 90s, early 2000s, I spent about 8 years as a broker. And 9/11 kind of killed that career. But most of, you know, I know the age group that I get as subscribers. I know most of you guys are my age, you know, thereabouts, all right? So we remember the days of where you had that financial advisor, if you will, to talk to. And if anything, you know, I know everybody complained. Trust me, I heard it when I was a broker. It's like, you know, what do you mean I got to pay these commissions to you to buy the stock or whatever? Well, you were also paying for the knowledge that I had, that I got from the firm I worked with or whatever it would be. And a lot of times we were a sounding board for the investors. You know, I'd have an idea, I'd run it by a client, and maybe they'd take me up on it, maybe they wouldn't. A lot of times I'd have clients call me up and say, hey, I heard about this company and I want to invest in it. What do you think? And sometimes I'd look into it and be a good idea. Sometimes I'd look into it and say, you're an idiot, okay? And now, was I right all the time? Absolutely not. I mean, I can remember, being honest here, guys, I can remember back in the late 90s telling people, oh, don't buy Amazon. All they do is sell books. Who the hell reads books anymore? Everybody's doing everything on the computer, okay? Obviously, I was wrong, okay? If you would have bought Amazon back in the 90s, you're doing pretty good right now. On the other side of the fence, I also remember when everybody was buying Enron like it was going out of style, and all the brokers in the office are like, oh, buying more Enron. I'm like, this makes no sense. And I was telling clients not to buy Enron. And a lot of clients fired me, too, for telling them this. Turns out I was right. You know, so it went back to the old saying, you know, when the client made money, it was because of the client. When the client lost money, it was because of the broker. Okay, that's kind of the running joke. But what wound up happening, and part of the reason I wound up leaving the industry, besides 9/11 and what happened in the market afterwards, was you also had the advent of online trading, okay? The E-Trades, the Schwabs, the Ameritrades, and everything like that. And, you know, I don't remember what it was, but, you know, back in the day, it was, I don't know, $9.95 for an online equity trade or something like that. I mean, it was a lot cheaper than what the brokers charge. And I totally get it, okay? And I said to people all the time, you know, you don't need to talk to me to know if Microsoft is a good company, okay? But, you know, for some of these other 4- and 5-letter stock ticker names, you know, yeah, maybe you want to ask somebody about it. Well, over time, that's kind of gone by the wayside, okay? You know, brokers aren't commissioned anymore. You know, they're fee-based and asset-based and everything like that. So, you know, the brokerage firms still make money, don't get me wrong. They just changed the fee structure. But it brought out the advent of companies like Robinhood, all right? And then Robinhood came out, no commission trades, great. You know, and then you had the Schwabs and whatever started following and saying, you know, we're charging no commissions whatsoever for an online trade. Well, it goes back to you get what you pay for, all right? You're not paying for anything other than the execution of the trade. So you had nobody to talk to and say, hey, is this a great idea? Or is this, you know, or am I all wet? And so what you wind up happening is what we've seen here this week with companies like Gamestop or AMC Theatres or American Airlines or something like that, where the volatility in these things goes crazy, all right? Now, you know, back during Trump's presidency, you know, he used to say, oh, the stock market's doing great. The stock market's doing great. And yeah, it was. Okay. You know, I mean, we hit 18,000 at the beginning of COVID. We were back at 30,000 by the time Biden was sworn in, you know. All right. There's what, a 60% gain if you bought, you know, year over year. If you bought in March and sold in January, you know, you had a great return. A lot of people's 401ks saw, you know, not only the recovery from what they lost when the market went down, but anything else that they were putting in, they saw some great gains out of it. So that's a good thing. Okay. But the market does not tell you what the health of the economy, all right? And again, you've got to remember who the players are in the market. You and me and everybody that invests their 401ks, yeah, we're in the market, but we aren't a dent in what happens, okay? You've got these hedge funds and huge institutions that are, you know, trading millions upon millions upon millions of dollars every day, you know, and, you know, you put your $120 contribution in out of your 401k plan each paycheck, you're not moving the market, all right? So the ones who stand to gain the most, again, are those rich ones, as I talked about at the top, who are gaining more and more and more of the equity, okay? And we get the crumbs thrown on the side, you know. I mean, 1% growth on $120, you know, great, it's $1.20, okay? 1% growth on $1 million, all right, now you're talking about a lot, you know, significant amount of money here, all right? And they're doing this all the time. So what happens when you get something like GameStop this week, all right? You had one of these hedge funds that when the stock went up to about 200 for no reason or whatever, came out and said, oh my God, the stock is, you know, it should be back to 20 bucks, everything. So they started shorting the stock. And if you know what that is, that's when you borrow the stock and sell it, hoping to buy it back to pay back the stock you borrowed at a lower price, and you keep the difference, okay? Well, you had all these hedge funds start shorting the stock, except the stock kept going up. Okay, so now if they were shorting at 200 and now the stock's at 300 and they've got to buy it back at 300, they lose that $100 in between. Okay. Well, if you saw what happened here today is Robinhood and all these other companies stopped allowing the individual investors to trade in GameStop and just allowed the institutions. Now, if that ain't crooked, I don't know what it is. So Big Wall Street got to protect, you know, cover their losses or do whatever. And Joe Average is sitting on the sideline watching the stock go like this, and he's just counting money and he can't do anything about it. Okay. So in steps Washington. All right. And Moses must have parted the Red Sea today because for some reason, Ted Cruz and AOC agree on something. Okay. Never thought I'd see that in my life. But in this case, they're both right. Something's crooked, all right? So what I'm telling you guys is this, all right? Do not look at the stock market as much as everybody's going to try to tell you and say, hey, this is the way the economy's going, all right? The stock market's going the way the World Economic Forum wants it to go, which is not the way we want it to go. You know, I use Bitcoin as an example, all right, for this. Just so you guys know, when the masses all of a sudden think something's a great idea to buy, that's when you want to sell, okay? And like I said, I use Bitcoin as an example. Look at beginning of January. Everybody's going, oh my God, look at Bitcoin. It's over $30,000. I've got to get into Bitcoin. Look at Bitcoin today, a month later. It's down about 25% from the beginning of January. So congratulations if you bought Bitcoin at the beginning of the year. Your 1 month return is a loss of 25%. Okay, that was the time to sell. When the masses come in and say, it's time to buy, that's when you want out. All right. Easier said than done. But I'm going to use this as an analogy. I will guarantee none of you have ever walked into the grocery store and saw a can of beans that normally sells for $1 on sale for 50 cents and said, nah, you know what? I'll wait till it goes back to $1 to buy it. But that's what everybody does in the stock market. Okay, they buy high and sell low. Nobody will admit it. Okay, everybody wants to buy low and sell high, but the majority of individuals buy high and sell low and lose money. Okay, so do yourself a favor and, you know, take the money, whatever you're investing. I mean, we've talked about gold, silver, everything like that. You know, I'm a proponent of silver, but not of copper and gold. You know, go that way, but watch the prices on silver again. Don't start getting in, buying at the top, and then getting stuck holding it. Even though it's a physical asset, you got it, and over the long haul, it should do better. But be careful of where you're buying it. You know, same thing with anything else, guys. You know, pay attention to what the prices are. You don't want to be buying high and selling low. You know, you don't want to be buying that can of SpaghettiOs for, you know, $1.50 when last week it was 89 cents on sale. Pay attention to your prices. That is extremely important. It'll make your preps go a lot longer if you read the grocery store inserts in the Sunday paper. Go online and check out your grocery store for their online coupons. You can save a ton of money doing that sort of stuff, okay? But keep an idea. It's like I mentioned tuna in yesterday's video. If you went to the store today and you paid 88 cents, let's say you went to Walmart, you paid 88 cents for a can of tuna. Write it down in your book saying I paid 88 cents. And then now that's your baseline, because now when you see it at 77 cents, you know to buy more. But if you see it at 99 cents, it's like, hey, maybe the price comes down. You know, wait for it to go on sale. Not that it'll work all the time, all right? But at least it's going to give you a baseline. If you know what the regular price is and you write that down, because we all know this. Companies do this all the time. Something's $1 on Tuesday. On Wednesday, they raise it to $1.25. And then on Thursday, they say, oh, it's 20% off. It's back to $1. No, it's back to regular price. It's just anybody who was stupid enough to buy it when it was $1.25, you know, got hosed. So that's what I'm saying, guys. You know, with the whole stock market thing and, you know, the American Airlines and Gamestop and AMC Theatres and stuff like that, don't even listen to that. Don't play in those games. Please don't be one of these people trying to chase get-rich-quick money. There's too many college students out there doing that probably going home to mom going, Mom, I don't have money for groceries because I lost it all on Robinhood by, you know, buying some silly stock. You know, they're thinking they're some 19-year-old genius in the stock market. Good luck, okay? And y'all know my investment theory. I mean, stick the money in the S&P 500, leave it be, and don't touch it. Just let it do its thing. Not that I'm giving anybody any financial advice, okay? Certainly not doing that anymore. I'm out of it, but I just, you know, I'll take a little bit of risk, but I'm not going to be stupid. Like I said, if I want to go play these stocks and stuff, I'll go sit at a blackjack table. You know, my odds are better. But, you know, pay attention to the prices of things. Don't be one of the ones that buys high, you know, and winds up selling low. And do the same thing in your preps. You know, make sure you can find out how to buy low, okay? Make your money go longer. Get your preps filled up faster. That's what I got today, guys. I'm sorry if I bored you with financial stuff, but every once in a while we got to talk about something different. So have a good Friday, y'all. Talk to you soon. Pinball out.